Hey, welcome into the Craig Houston podcast, man. Been waiting to have a great conversation talking about all things about how the market is actually shifting, what we're seeing from interest rates, and talking to you about a lot of things when it comes down to just having a conversation about how buyers should be looking at this market and how they can actually find great ways and incentives to actually take advantage of what the market is actually offering right now as we're starting to shift into a downward swing on what we're seeing interest rates are going right now and what we're seeing with home prices. So my guest today is Oscar. Oscar, introduce yourself to the audience, man.
Hey, how's it going, everybody? My name is Oscar Avila. I'm actually a mortgage loan officer with a VA Choice Home Mortgage in Virginia Beach.
So how long have you been a lender, Oscar? Let's talk to the audience about that a little bit.
I haven't been doing it for too long. I've been doing it for about 4 months now. I just recently transitioned out the military, so now I'm doing this full time.
That's awesome. So what made you want to become a lender? Let's talk about that for as a loan officer.
Okay, so about a year ago, I was still in the Navy at the time. I bought a multifamily property. I bought a duplex. And during that process, I kind of got an interest in like personal finances and real estate. So I actually reached out to the loan officer that I was working with, and I kind of like asked, "Hey, what did you do to become a loan officer?" And then she told me what to do, and I kind of implemented the steps from there. And then about September of this year, I got my license, and now I'm doing this full time. So that's kind of the short story of how I got into becoming a mortgage loan officer. But yeah, just I like personal finances and real estate really.
Awesome. So you have actually got into the space at a weird time, right? Where you basically seen the market be so hot the last couple years, and now you are now becoming a loan officer, helping people obtain pre-qualification and qualification for these mortgages. Now, how has that shift in this market been for you in business?
So yeah, since the start of 2022, actually interest rates have been rising like nonstop. And recently they kind of like cooled off and like dropped down just a little bit, but it's definitely been challenging coming in, becoming a loan officer and going into this market because a lot of seasoned loan officers are actually leaving the industry, even real estate agents too, which is kind of crazy. So I'm just keeping my head down, blinders on, and I'm just gonna out here and kill it. That's the goal for next year.
I'm actually pulling some up right now that I want to share with the audience. I showed it on my Instagram last night, but I'm gonna show it here as well if I can get it pulled up about what you just said about the interest rates, how they have shifted so much in the last year, which is so. I think seeing the imagery of it makes give people a different perspective if you're watching this on the video. So what we're gonna do is I'm gonna pull this up real quick. Just keep dropping it for some odd reason. I'm gonna pull it up real quick so we can see this. I'm gonna do it here. So check this out. Basically, as Oscar was saying, is that if you're looking at interest rates, I'm gonna hide ourselves real quick so we pull this up full screen. But you see that in the January 6th, interest rates was at 3.22, and we saw it peak twice to about 7.08 across the board. And now, according to Freddie Mac, we are sitting around as of last week at 6.31% on average about interest rates. So has that something that you've kind of seen that compression happen a lot in the markets that you've been kind of like trying to get your head wrapped around?
Yeah, so when I first got in the industry, well, let me backtrack. When I bought my home like a year ago, rates were at 2.5%, and that's what I locked my duplex at
Oh
2.5%.
man, you got a good deal, man. That's a good
Yeah,
deal.
yeah, I know. It's a killer deal, but yeah, so as soon as I got in the industry, that's when rates were like around 5%, but then they just start well, like around 4%, and then they started going up and up and up. And I was like, wow, this is kind of crazy because a year ago rates were really low and people were buying homes like crazy. And now that rates we're going up, a lot of people were cautious on how they would spend their money, you know.
That's really some that I had a conversation with a potential what a potential client. They're not a prospect. They are not in the market to buy just yet. They're trying to wrap their mind around what they want to do. So they're like in that warm. They're not a warm lead. They're like a nurturing lead at this point in time. And they basically had a conversation of where they was unaware because they already owned their home for a while. Were unaware of how home prices have shifted in the market in the last 5 years. Like it's so crazy when you tell somebody now what they think when they look at the home that they had and they're looking at upgrade of the home that they have, they don't realize the sticker shock value of it, right?
Yeah.
So it's so crazy. Now you add on top of that interest rates going back up higher now, getting 2.5, but looking at maybe 5%. It changes the thought process of clients at this point in time. Have you seen that as well?
Yeah, I've definitely seen that from like from my inner circle because people are cautious of like buying homes because of they're still expensive. Um, and sellers are still in that mindset where they can get top dollar for their home. But in reality, interest rates have gone up. People are more cautious how they spend their money. And then we also have the news about this like recession that we're in. So there's a lot of, I feel like the media plays a big factor in it and is just telling all of this news to a lot of people and they really aren't educated. So whatever happened last year, they're still like, oh, home prices are should still be top dollar with in all reality it should actually be, there should be a negotiation when it comes to selling homes at this point, I believe.
I think you said a great point there when you said education is what people are lacking in a lot of these scenarios that we're dealing with. And one of the things that I think people give me a hard time about, and I try to be, not just an advocate for realtors or not even in this case, even lenders, but I try to be an advocate for the consumer, the client, to understand that prices are really not going anywhere. Like everyone imagines 2008 all over again in a lot of ways. And I have seen in a lot of cases where 2008 is not even coming close. And like right now, if you really look at the charts of where especially Hampton Roads, if you look at Hampton Roads, how we've seen home prices go in the early of 2022, we're basically back at the beginning of the year in median home price value. We're not below that. We have not slipped below that. We may slip a little bit beyond that, where we may go down a little bit lower, but it's not going 20-40% drastically like a lot of financial gurus on internets and YouTubes have said that we're going to experience. What's your take on that?
Yeah, so talking about 2008, yeah, I heard a lot of people, hoping that, oh, I hope like another 2008 happens and home prices just crash. And what I want to say, like to those people, it's my personal opinion, that it's like you don't want that to happen. If
Right.
home prices crash, the whole housing market crashes. That's something that you don't want to happen because millions and millions of people are going to suffer because of that.
Exactly. And that's where I think the market, where the Fed has gotten this right. Where a lot of people give Fed Chairman Jerome Powell a lot of grief about a lot of the things that has taken place to actually get this soft landing that he predicted a long time ago, which is, a lot of people are saying that it's getting rough. But what I will say is that we don't see the foreclosures at the same level that we seen in 2008. I think lending practices have been a whole lot tighter and a lot more stringent versus what we
Oh yeah.
saw ahead of 2008. So to me, I think a lot of people are getting the narrative confused on what they think they're going to experience. I know people thought that we was going to see 10% interest rates, 12% interest rates. I think at one point in time we could have seen this thing get away from to that level, but the way that we've seen the latest numbers and consumer price index, things of that nature, has kind of like tailored off a lot of that conversation recently.
Yeah, so when you talk about how a lot of people have this common conception that the mortgage industry is, there's a lot of predatory actions when it comes to the mortgage industry, but in our reality, it's super like hard to get your mortgage license because you have to pass your test, you have to do your class, you have to have a good credit score, and you have to pass a background check. So yeah, so 2008, that's a long time ago. That's history. So now there's a lot more regulations when it comes to getting your mortgage license. And what a lot of people should actually, take a look at is the automotive industry. I've heard that there's
Mm.
like a lot of, predatory lending when it comes to in the automotive industry, and that's why we're seeing, car prices, you know, 20, $30,000 markups because there was a lot of predatory lending that was going on in the automotive industry.
That's something I have not heard anyone say to me in the last year. That's really an interesting take, Oscar. Like I guess I could see that because used car values have increased drastically, and now they're tanking. Right? If you look at the CPI data, it was not even no inventory of new cars at one point in time. You couldn't even find a new car on the lot. If you did, it was only one, and it wasn't the model that you wanted. So I can see that too. Man, that's a great take. I don't have any substance on that, but I have seen the data that suggests what you're saying is absolutely right, that you probably are getting stuck with a bad deal in automotive. And matter of fact, I saw a post last night where the average consumer now who has a new car in the last 2 years is paying about average price $600 to $700 a month on that new car.
Yeah, so actually I've seen that, a lot when it comes to these applications that I see, people have $600-700 car payments, and it's
Wow.
absolutely like shocking to me that
Wow.
people would take on that much debt for like a depreciating asset. At one time between 2020 and 2021, and maybe a majority parts of 2022, that depreciating asset would sell over list price. We get that, but that's living in an upside down world. You know, when does a depreciating asset go over 20K over asking?
I'm sitting here and I'm trying to figure out what kind of car do you have if you're getting a $600-700 payment. That's almost buying a Tesla at this point.
Man, you'd be surprised. It just I think I've seen it just like regular cars, like new Nissan Altimas, new Jeeps, stuff like that, man.
Oh no, you have just blown me with that one. Oh man,
Yeah, man.
I did not expect this. That's crazy. Wow. I didn't really truly okay, so let's talk about that from a debt to income ratio. When you see that as a lender, how do you react to that as when it comes to helping that person purchase a home?
So it just depends. Like, if somebody's not making that much money and they have a 700,000, not 700,000, $700 car payment, it definitely kind of is like, it's kind of a bummer to me. It's like, dang, like they're
Yeah, because that's fixed debt. There's a difference between fixed debt and what you actually have as fluctuating debt, right?
yeah, yeah, because it's fixed for a good time period. It's not like a credit card
Right.
that's has a $3,000 balance, and if you have 10 grand saved set aside, you can pay that off, right? Um, but when it comes to these like huge car payments, and then when you deal with like lower income people, it's definitely a bummer because that plays a huge factor in their debt to income ratio. If it's somebody that makes a pretty good amount of money and they have a high car payment, I could kind of live with that and help them out to get the kind of home they want. But it definitely sucks seeing a $700 car payment, and you have this guy that has a goal of getting like a $300,000, $250,000 house, but half of his income is going to his car, and that sucks.
I wonder, you know what? I got to look into this. I got to look into loans on vehicles lately. That has me like, oh man, like taking a seat here for a second. I really am surprised by that number, but I can see it. I can see it because you can see how many people are like, okay, like I ain't seen young adults, and I'm not saying young adults don't have their life together at 22, 23 years old, pushing Teslas, and that has to be on certain income fixed. That has to be about a $900 payment.
Yeah, it's up there. I know that for a fact. And then I have a buddy that works at a tow company, and he recently said that repos are on the rise. He's been repoing more cars than ever before. So if that kind of gives you an inside look of what's going on out there, is like, are people actually making these payments? So what was going on with this lending in the automotive industry?
Well, I guess the lend. So you were, I would. So man, I don't know how we got on the tangent about automotive, but this is really a good story because like this is actually like right now, if you're watching this or you watch this later, this is definitely gonna be a clip because this is something that a lot of people are unaware of, I would imagine. But I would say when you think about it though, you have to look at it from a perspective of, let's say you owned a house during the pandemic,
Yeah.
2000,
Okay.
2020, 2021. If you own a house and you heard the news cycle and the Fed come out and say mortgage forbearance, you don't have to pay your lender your mortgage while this pandemic is in a state of emergency where you can just roll those payments to the back end of your loan. Could you see people taking the income that they would have been paying on a mortgage to go purchase a new vehicle?
Hmm. So yeah, I'm not too sure about that, but I think what it played a big factor was those stimulus checks, you know.
I
That
believe the stimulus checks did play a factor, but I'm thinking about people who was like, okay, this $1,700 payment I don't need to make this month because the government told me they're gonna put it on the back end of my loan. They're not gonna make me foreclose on my house, and they're not gonna make me pay it right now. Like, how many of those payments can I skip as well as getting those stimulus checks? Can I put this towards the
got it.
car?
Okay.
You see what I'm saying? And now I'll afford
Yeah.
the car, and but now in actuality, now I gotta afford my mortgage and I gotta afford the car payment that I didn't completely buy off at the same time.
Yeah, so I could definitely see that happening. You know, a lot of people try to take advantage of like the situation that they're in. And you know, once you see, you know, you don't have to make I guess a payment, you know, that money starts saving up. You can start saving up that money. You can see the things you can afford at the time. But you know, a lot of people don't take a step back and look at the greater picture of what's going on.
Exactly, exactly. And that's my point. Okay, so man, let's talk about where are you seeing or okay, let me start over. Let me ask this question off. I have seen where stats have came in where mortgage applications have decreased, but now they're starting to actually taper back up and start seeing more increased focus on mortgage applications. Is that true?
Um, I would say so on my end
Okay.
because I'm like newer in the industry. And you know, the first 6 months in the industry is definitely like hard because you don't have a lot of applications coming to you. You got to build up that network that you have to build with real estate agents and referral partners and so on and so forth. But I've recently seen like an increase in applications that I'm getting. So I don't know if it's from my hard work of just going out and meeting people and shaking hands, or if because the market's actually, you know, going upwards in a trajectory.
Yeah, so I would say my I guess the another a follow-up question to that is because you are putting in that work. This is how we got to this point right here, but we met and
Yeah.
then now we're like, hey, let's put this on tape so we can always have this conversation with people. I would say what is okay, the better question I would say is average interest rate that you've been locking in or you've been actually proposing lately. What is that looking like?
So as of lately, so when it comes to FHA and VA, like government-backed loans, recently I've been able to, you know, don't have the APR on hand, so I don't want to like say
No,
an
that's
interest.
fine. Yeah,
Yeah,
that's
yeah.
fine.
So like low, you know, high fives, I would say.
Okay.
Um, yeah, high fives, and then the month before then it was like in the sixes, you know. But we're a mortgage broker. I'm a broker, so I can like shop around with, you know, multiple lenders, and then we deal with wholesale rates, which are usually cheaper than going to like a lender, like a bank or I don't want to name any names out here, but you know what I mean.
Right. Thank you for the clarification, right? Because I know people are wondering, okay, what's the difference between a lender and a mortgage broker? And you're breaking that down for us. I appreciate that, and that's a significant difference here, and that sometimes can work in the favor of the client, right, for them to get a better rate than they possibly could at a local branch.
Yeah, yeah, it definitely could. You know, just you know having a half a percentage rate better, you know, would save the client like thousands and thousands of dollars like throughout that 30-year span. And then ultimately it comes down to their monthly payment as well. If they have a lower interest rate, they're going to have a lower monthly payment theoretically, right?
Right. Theoretically, right? Yeah, that's
Yeah.
true. That's true. Okay, so let's talk about exactly what we hear that a lot of people want to know from a mortgage broker.
Okay.
What do you believe we're going to see in 2023 when it comes to interest rates, in your opinion?
In my opinion, yeah, because you know, they can't, like I said, nobody can predict what the market's going to do, right? There's this one guy, Barry Habib, who is pretty good at predicting what the market's going to do. And then a couple months ago, he actually predicted that interest rates will be in the fives by this year. A couple months ago. So if there's somebody you want to kind of get your prediction from, I would say go to Barry Habib, look him up. But in my personal opinion, I believe that yeah, interest rates are going to stay kind of in the fives. You know, the first quarter, I believe, because you know, everybody's talking about this like recession that we're in. A lot of people are cautious about spending money. And then also, the consumer price index report came out where inflation that is actually lower than expected. So, you know, I believe interest rates are just going to stay consistent for a while because they're going to try to, you know, stimulate the market because people are cautious about spending money. And then 2022 interest rates were high, so a lot of people weren't actually out there purchasing homes.
I believe there's some that if people have watched this channel for a while, it's something that I believe where I'm like, okay, we need to see a little bit more data before the Fed gets off their tape. So right now, people believe that I believe that people believe that the Fed will continue to do this 0.25 interest rate hike over the next couple months. And I believe that they're actually right in a sense, but I think they're waiting for, I want somebody to pull it up right now. I think they're waiting for more information. And the information that I believe that they're waiting for is certain months that they want to see perform at the level that they want to see them perform at before they take their foot off the gas, right? And I'm going to share those right now. Okay, so I believe that the Fed currently, in my belief, is waiting for the months of March, May, and June of next year to see where those inflation numbers come in at before they decide to take their foot off the gas on raising the federal fund rate. And the reason why I say that is because both of these 3 months here are over 1% in inflation growth. So they want to see where those months come in at before they take their foot off the gas. And I think we may see, I believe we may see a hike of interest rates go up around in the markets around this time. Is that something does that sound feasible in your opinion? Off my take?
Yeah. In my opinion, yeah, I think it kind of does make sense because those months, that's when, home prices start to pick back up again.
Okay.
So I believe, more buyers will be, when it comes to real estate, a lot more people are going to be wanting to spend money. So, you know how in 2021, or what was it, 2020, whenever they lowered interest rates,
Right.
they wanted to stimulate the market, So I think they're trying to be cautious about doing that again, having lower rates during those times because a lot of people are going to jump in buying real estate. So that's very possible for, I believe that we could see that, happen.
So yeah, I mean, obviously, I'm not a mortgage lender, and you know way more about this than I would. But I just feel like I got this vibe where 6%. If we're lucky to be at 6% around that time, if things go the way they should, and then it can decrease back down to 5 or whatever and stabilize there. But if they're around 6 already, it would probably make the Fed feel like they still have control of what's going on and not make them feel like they got to be reactionary and raise by 0.75 or 0.5 again, like they need to.
Yeah. I mean, I could definitely see that happening. It's just so hard with the mortgage industry. It's like, or you can't really predict what's going to happen in the market. That's what's so tough.
Yeah, it's so
Yeah.
tough, right? I agree with you. Okay, let's talk about. Okay, I'm sorry. Go finish up.
Yeah, just like a guessing game. It's like, oh, what do you think rates are going to be? Because I get this question all the time. Oh, what are rates going to be? A month from now, 2 months from now. I was like, man, I can't predict that, man. It's kind of crazy.
And that's why I say to people so people ask me all the time. They say, I don't understand how people are buying houses or how people are selling houses at this point. And people don't realize that interest rates has little to nothing to do with people buying or selling a house. I ask people this all the time. When they ask me this question, I hit them with another question. I say, why do you think people are buying or selling a house? They're like, well, because they just want to sell it or because they need equity or whatever. I'm like, those could be reasonable expectations, but really and truly, it comes down to life events or what really affect people when it comes to buying a home, selling a house, or whatever. We don't really pay attention to why the need of buying or selling a home comes into play, but it's usually some type of life-altering event that usually follows it, and no one cares about the interest rates at that point.
Yeah, that is true. That's one main thing that I try talking to a lot of like people in my inner circle and like a lot of these potential buyers that I talk to is like you can't time the market, and the best time for you to buy a home is whenever you're ready.
Right. And you're going to figure that out. You're going to figure out the affordability at that point in time.
Yeah, like if you're able to afford it, now, and you can see yourself living there between 5 to 8 years, because that's like the average person that spends in their home, and whenever they, because after 5 to 7 years, they like sell the home. So if you can see yourself living there 5 to 7 years, and you can afford buying a house, and you think you're ready for it, then I would suggest go ahead and do it. But and then it comes down to like financial responsibility too. Don't get a crazy car payment. I mean, get a car you can afford, right? Don't get a $700, $800, $900 car payment when you make $3,000 a month. That's like a third of your income right there.
Right. Right. Absolutely. So like that's what I think people don't really pay attention to a lot. And so when they say, "Hey, why did you get into real estate?" I'm like, it's not about the market. It's about helping people find what they really need, adjusting to the life altering event that they've came across. That's really what it is. So let's talk about really and truly let's talk about some of the services that you really provide clients and some of the things that you've been able to walk some clients through. You don't have to give us names or no details majorly like that, but just some of the things that you can actually do to help prospective clients that may want to actually seek out your services.
Yeah, so I would say, the most important thing when it comes to like home ownership is just, figure out your financial situation because, which sucks to say, a lot of people don't have a full grasp of their financial situation until they go to somebody for help or they go to financial advisor. And for a lot of people, the first time they meet with somebody in like the financial services is a mortgage loan officer or a mortgage broker, which is kind of crazy, But yeah, the services like I can provide for them is just to, take a deep dive into their finances, seeing what they can afford, how much purchasing power they have, what their debt to income ratio is, and if they need help getting there, that's also part of my part of my plan as well. Like I would guide them, tell them what to do. Like, oh, you need to eliminate these debts. You might need to sell your car. You might need to, pull money from your TSP or your Roth IRA to make this down payment. Just kind of advise them what to do, really.
Got you. So when it comes down to it, are you seeing more VA applications come in or FHA applications come in, or even
So,
conventional?
yeah, I mean, it's just like a mixture. I think like right now where I'm at in my career, it kind of, I don't want to like, it sucks to say this, but I'm kind of getting like the not the bottom of the barrel, but first time a lot of first time home buyers.
All right.
Yeah, so a lot of first time home buyers. I came across VA, conventional, FHA, and just people getting into their first home. So
Right.
that's what I've been seeing. Just a mixture of people in our area. There is a lot of VA buyers because we're in a military town. So yeah.
So I mean, so like, okay, so the VA product. It's a great product. I think for anybody who's a first time home buyer, especially if you're in the military and you're trying to get into a home, I think the VA product is ideal. You get zero down. You have the funding fee obviously, but you don't have to pay mortgage insurance on it, and you basically don't have to bring. You basically just got to make an earnest money deposit and then hope. And then if
Yeah.
you get seller concessions, you can basically walk into the house for no money at all, really and truly.
Yeah.
At the end of the day, right? So like
And,
in my
yeah.
like for example, my house in San Diego, I mean, sure, man, I was what like E6 at that point in time. I was at E6 in San Diego. I walked into a house in right out 20 minutes away from downtown San Diego, no money down.
That's kind of
Like,
crazy.
yeah,
What year?
340,000.
What year was that?
2014, right?
2014. What
What
were rates back then?
my rate back then was 375.
375. That's
And
great.
the seller paid closing costs. And I walked into the first day I moved into the house, I opened the mailbox up. I had a check back in escrow for like another $1,800 because I overpaid off my earnest money deposit.
Damn.
Like the craziest thing ever, right? Craziest thing ever. So this is a great product. Like, so I'm an advocate for the product because I see it. But I think when I started thinking about real estate though, as a realtor, I seen a lot of homes avoid VA a lot.
Really?
What would be some of your reasons why that would be the case? Why they would want to avoid a VA applicant?
Because you can't do an appraisal waiver on a VA loan.
Boom, there you go, my man. Yep,
Yeah.
that's exactly it, right? And that's what and I think now that we're getting back into this market, any buyer that shows up now has a willing participating chance of actually earning the business. But beforehand,
Yeah.
it was crazy. You had to be like overqualified on the VA loan for somebody to be like, okay, I'll deal with you at that point.
Yeah, and that kind of sucks because whenever you're like a service member, you're like going to a different duty station and you're trying to buy a home, and I mean, it's just coming from like my heart, like if somebody was like, let's say I was trying to sell my home and I had options between like a VA and a conventional loan, I'll probably go with the VA loan because, oh, this dude was in the military. He's probably coming over here because he needs a place to stay with his family. That's my thought process. But a lot of people don't think like that.
I bought this house that we're in now in June. In June, we bought this. We put the offer in on this house in June, moved in July, and I think the only reason we got this house, we had 14 different offers. And I had a good agent. I'm a realtor, but before I became qualified, we were certified. But when I got my license, I was getting my license around the same time, so I was using an agent.
Okay.
And the agent I had, he was good. He was a military veteran as well too, very good. But it was 14 offers in on this house. And we went, and I don't know how many VA applicants it had, but we did have to pay over the appraisal price to get it. But luckily, the appraisal came in underneath the asking, and we closed it out very well. But it was obviously, I was like, man, like I think if it wasn't being the person who had this house before us was a veteran, I don't think we would have got this house.
Really?
I don't think so.
That's kind of crazy.
Yeah, I don't think so, because we had put other offers in on home. We had put 4 offers in before we got this offer accepted, and on different houses. And each one of those houses, either we got outbidded by price or over appraisal, or they just went with a different loan type, I think.
Got it. Yeah, that's what I was in the same scenario last year when I bought my home. Because we put in an offer at 238, but we did the escalation clause up to $248,000. And I remember whenever they did their appraisal, I was like hoping that they appraised at 248 because I didn't want to cough out 10 grand.
Oh man!
I mean, I was going to do. I was ready to bite the bullet.
Right.
Right.
But,
yeah, I was so lucky when they appraised out at 248, and